Recently, news broke out that SoftBank may have played a major factor in boosting the tech stocks. For those of you guys interested in learning more about the life of Son Masayoshi, who is the founder of SoftBank, and how he became to be known as the Bill Gates of Japan, I made a video about the man several months ago, so make sure you check it out. Link will be in the description. But going back on topic, apparently SoftBank has been buying billions of dollars worth of call options, which are basically contracts to buy shares of a company in a future date at a set price. And apparently, SoftBank made about $4 billion in gains through these call options, but their share price tanked 7.2% because investors see this investment as a very risky play. Because if the market drops below the call price, then their call options will become worthless. But how exactly does a company buying call options cause share prices to go up? Well, first, the action of buying call options is a bullish move because the buyers of these call options are paying a premium to buy shares of a company at a later date. So when there's a large spike in demand for a call option of a stock, the market sees this as a signal that some large investor knows something that they don't and expect the share prices to go up, at least in the short term. And since there's more demand for these call options, the people or institutions that write these options may want to hedge their positions by buying the shares that they are selling call options for. Doing this is a defensive move by the call writer in case that the share price of the underlying stock actually goes up. So the big question that's on everyone's mind after the pullback is the stock market actually in a bubble already? To answer that question, we have to know how to value companies. There are many ways to value companies, but one of the most common ways to value companies is to look at its PE ratio, which stands for the price to earnings ratio. And the PE ratio is a very simple concept. Basically, the ratio shows us how much investors are willing to pay for $1 of the company's earnings. So, if the company is trading at a PE ratio of 20, then investors are paying $20 for every $1 of the company's earnings. So the higher the PE ratio, the more people are willing to pay for every dollar that the company earns, which means that investors believe that the growth of the stock will be able to make up for the higher PE ratio in the future. And to calculate a company's PE ratio, you need two things. The first is the company's earnings per share, also called the EPS. And the second thing you'll need is the company's share price. The share price you can look up in your brokerage or on a website like Yahoo Finance. And the EPS you can usually find on the company's financial statements or most financial websites. And once you have those two, all you do is divide the share price by the EPS. So the formula for a PE ratio is the share price divided by the EPS. And right now, the S&P 500's PE ratio is sitting at about 28, which is a lot higher than the historical average of 15. But if we compare it to the times of the dot-com bubble, we see that the S&P 500's PE ratio was 46, which could mean that the market still has some ways to go before it reaches bubble status. And during the dot-com bubble, there was a massive amount of new tech companies that haven't proven a profitable business model coming onto the public market. In the year 1999, there were 486 companies that IPO'd, but in contrast, there was only 159 in 2019, and only 43 from January to June of 2020. So one big difference I see between the dot-com bubble and 2020 is that there aren't as many unprofitable tech companies coming onto the public market. Another very similar metric that investors commonly look at is the Shiller PE ratio, named after Yale University Robert Shiller, who won the Nobel Prize in Economic Sciences in 2013. And this ratio is not very different from the regular PE ratio, The only difference is that to calculate the Shiller PE ratio, we take the price of the market and divide it by the per share earnings over 10 years instead of the current per share earnings. So instead of using the earnings from one point in time, this way of calculation eliminates the fluctuations in net income caused by variations in profit margins over a short period of time. And the Shiller PE ratio right now is at about 31, which is still quite a bit lower when compared with the dot-com bubble in the early 2000s when this number reached the mid-40s. And investor Bill Ackman, who turned $27 million into $2.6 billion at the start of the pandemic, also does not think that this is the beginning of the end of the stock rally.
The worst day for the NASDAQ since, my gosh, March, which is a time around when you were pretty public about the market as well. I'm curious what you think of this particular trade today. Is it just some market jitters at the beginning of September, or is this the beginning of the end?
Yes, it's certainly not the beginning of the end, but I would say we're coming upon one of the more uncertain periods in American history, right? We have a very divisive presidential election, coupled with a virus that's had a huge impact on the economy, and the markets have been remarkably strong since really the third week in March, and so it's not surprising. Valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty, and we have an election in 60 days where it's a toss-up who's going to be the next president and what the policies of the next president, whether it's Trump's second term or Biden's first term, what that means for the country, what it means for corporate America, what it means for taxation. These are uncertain issues, and uncertainty, as I say, is the enemy of markets.
So Bill Ackman attributes the pullback in the tech stocks as a sign that investors are wary of the high uncertainty in obviously the pandemic as well as the presidential elections, where we have two candidates with two very polarizing views that could have a big effect on corporations. But again, I want to remind everyone that no one can predict if the market will be up next week or down the next week. So the best thing we can do in times of uncertainty is to continue investing amounts that you're comfortable with not having for several years, because the stock market will be uncertain in the short term, but over the long term, we have a better chance at growing our investments than trying to guess what is going to happen to prices in the short term. That's going to do it for this video. Please don't forget to subscribe with the bell notification icon turned on, and I will see you guys in the next one.